Does investing intimidate or confuse you? If so, you're not alone. In fact, we did a survey and found that more than 65% of women say that their main roadblock to investing is that it's confusing. And it makes sense. In high school, you probably spent a lot of time learning how to calculate the radius and circumference of a circle, but no one taught you how to make money in the stock market. So let me simplify a few things. Hi there, I'm Terry, financial coach here at Dow Jones, and today I'm going to give you 7 steps to developing an investment strategy that is tailored to your needs. But first, we're holding a masterclass to help increase your confidence in investing. In it, we explain our 4-step strategy for successful investing, how to break through the roadblocks that stop women from investing, and how to avoid losing money in the stock market. I'll leave a link in the description. If you want more free education on how to improve your financial wellness, be sure to subscribe and hit that notification bell so that you don't miss out on any future videos. Here's how to create an investment strategy. Number 1, set your financial goals. Start by clearly defining your short-term and long-term financial goals. These may include saving for retirement, buying a home, paying for college, or building wealth. And make sure that your goals are SMART, which is an acronym that stands for specific, measurable, attainable, relevant, and time-bound. Now, let's break down exactly how to create a SMART goal. First, specific. Be clear on what it is that you want to accomplish and how you're going to accomplish it. So, for instance, instead of saying, I'm going to work on my finances, instead say, every Wednesday morning, I'm going to make a cup of coffee, sit on the back porch, and I'm going to review my spending habits, look at my bank accounts, and then track my financial habits and my progress. Next is measurable. Set a very specific number so that you can determine whether or not you hit your goal. For example, I want to raise my credit score by 50 points, or I want to have saved $1,000 for an emergency. Next, after that is attainable. Make sure that you have all of the necessary skills and resources that you need to accomplish this goal. Relevant. A relevant goal needs to answer yes to the following questions. Does this seem worthwhile? Is it the right time? And does this align with my other values and my other goals? And then time-bound. Here you want to set a deadline. This could be something like, I'm building up $1,000 in the emergency fund in 2 months. For big goals like paying off student loans, you might want to aim for 5 years from now or whatever is reasonable based on your income. Next step, number 2, is assess your risk tolerance. So determine how much risk you're willing to take with your investments. Consider all of the following factors. First is your age, or more specifically, how close are you to retirement? Next is your investment timeline or horizon. How long do you have to invest? If you're planning to retire in 5 to 10 years, your money doesn't have as much time to grow. However, bear in mind that you don't take all of your money out on the day that you retire, so some of your investments will continue to grow for years to come. How about your financial obligations? Do you have kids that you're supporting, or a mortgage that you're trying to pay off, or maybe a car loan? What about your income? Is it stable? Does it fluctuate a lot? Next would be your comfort level with the market fluctuations. So if the market does dip down, are you willing to wait it out until it rises again? Understanding your risk tolerance will help you choose investments that align with your comfort level. Number 3 is understanding the different asset classes. Familiarize yourself with various asset classes, such as stocks, bonds, real estate, or cash equivalents. Each asset class has a different risk and return characteristic, and building a diversified portfolio across multiple asset classes can help to manage your risk and optimize returns. Here's a quick overview of some of the most common asset classes. Stocks. Now, these tend to be higher risk since companies can go under, but also higher return, typically between 8 to 10%. Bonds are often lower risk since you're practically guaranteed to get your money back, but it's also usually lower returns than, say, stocks. Now, real estate investment involves owning physical properties or investing in real estate-related securities. Direct real estate investing is when you buy residential properties, commercial properties, or land. You could also put money into REITs, which are real estate investment trusts. REITs are publicly traded companies that own and manage income-producing real estate assets, offering investors exposure to the real estate market with liquidity that's similar to stocks. Number 4 is to allocate your assets. Decide how to allocate your investments across different asset classes based on your financial goals and risk tolerance. This is known as asset allocation. Consider here your investment horizon, your liquidity needs, and market conditions whenever you're determining the appropriate mix of stocks, bonds, or other assets. If you don't want the responsibility of deciding asset allocation yourself, a target date fund will take care of all of that for you. All you have to do is input the year that you want to retire, and it will automatically allocate your investments based on the ideal amount of risk. Number 5 is considering tax implications. Be mindful of the tax implications of your investment decisions. Understanding how different types of investments are taxed, and consider different strategies to minimize taxes, such as investing in tax-advantaged accounts like an IRA or 401k. You can even leverage health savings accounts or HSAs for tax-advantaged investments. We did a full video on how to take advantage of HSAs, which I'll link to in the description. Number 6, decide how much you want to contribute. If you don't have any investments, decide how much you're willing to initially invest. Remember, even if an investment is highly liquid, meaning you can get your money out of it pretty quickly, you still want to give your money time to grow. So only invest as much as you are willing to live without. After you've made your initial investment, it's time to think about how much do you want to invest and how frequently you want to contribute moving forward. One popular strategy is called dollar cost averaging. Dollar cost averaging is an investment strategy that basically just involves consistently investing a fixed amount of money at regular intervals, typically monthly or quarterly. Regardless of current price on the market and conditions, basically you decide on a fixed amount of money that you're going to contribute and invest at pre-established regular intervals. For example, maybe you decide that you're going to invest $500 every month. This is a great long-term investment strategy like saving for retirement or just building wealth over time. Now, if you want to learn more, we've done an entire video about dollar cost averaging, which I'll link to in the description. All right, last up is number 7, review and adjust your portfolio. Periodically review your investment strategy to make sure that it remains aligned with your financial goals and your risk tolerance. Make adjustments as needed based on changes to your life. For instance, if you get a pay raise or if you pay off debt, you might want to increase the amount that you're investing. Or as you approach retirement, you might want to move to lower risk investments. All right, hopefully this helped to make investing a little less confusing. If you want to learn more about how to grow your money through investing, be sure to check out our free masterclass. Our Dow Janes co-founder, Britt, will talk about how she lost $10,000 in her first investments and how you can avoid making the same mistakes. You'll also learn our proven strategy for investing and how to break through the obstacles that stop most women from investing. I'll leave a link in the description. Hope to see you there.